Now that you know everything about sine wave, it is time to dig into momentum indicator. As you may have guessed at that point, momentum will be a kind of a confirmation indicator. Its basic role will be there to confirm and help you trade and get the best out of sine wave, because sine wave is the most important. It's the most complicated one, as we said. So momentum will be easier to get, simply because people are really generally more familiar with the momentum that they are with cycles. Everyone knows about momentum. You all know about the RSI, the MACD. You already crossed those two. Otherwise, I really suggest you pause that video and watch out for those two before you continue hearing this. So the momentum study is, let's say, very well known. In general, that's the first approach everyone has from the market, which is price derivative. Because momentum, the momentum study is what this is about, is simply creating price derivatives and see how price move against prices in time, against historical prices. Because momentum is going to tell you this, and only this. The momentum is the graphical representation of price structure and, let's say, price slope versus the previous slope it had. Means that whenever the price is going up and faster than it did before, you will see the momentum rising sharply, and exact opposite when you see the price going down faster than it was before. But the only difference between price and momentum is that momentum looks at price versus a short period historical prices. It basically looks back into 20 periods, no more than that. Your eyes in here can see more than 500 candles. So you can have global appreciation of the price. Momentum only has a look at the last 20 bars and see how price moves against those 20 last periods in time. And this gives you really reliable information, because everyone knows about the divergence you could see out of the momentum and the price, because momentum should move like the price is doing, but from time to time you will see slight differences, meaning that the price will make new highs and the momentum not. And this is what we call a divergence. There's also, of course, hidden divergence. Most people are not really aware about those, but they're really, really useful to trade as well. But anyhow and anyway, you cannot trade divergences just like that. You cannot trade bear signals out of momentum. You will need to have somehow confirmations about the cycles. And this is why you cannot trade sine wave alone. Neither can you do with momentum. And I see so much trader trading only out of momentum signals. If you trade a divergence, and if sine wave is not telling you to do it, then you're probably trading nothing. Just a divergence is not really a signal itself. It needs to be in time, in timing. And sine wave is taking care about the timing. Momentum is taking care about the odds you will see a reversal on that timing or not. Now let's get into momentum deeply. What are the signals? What are they coming out of? And what's the algorithm processing to get them out? So first question, what are the different signals we have right there? Because just as we have talked about it on sine wave, we need to talk about those. They're nearly the same, because you'll have bearish signals taking profit patterns, exit pattern as well, just like we did on sine wave, but you got a couple that is not into sine waves, which is called the divergent pattern. Of course, there's no divergence in cycles. You have divergent in momentum through price, momentum versus prices. So you've got the divergent pattern that wasn't present inside sine wave. New thing you have in momentum, divergent pattern. You've got bullish divergence and you've got bearish divergence as well when you have the red signals. Now you got other signals, which you got the little red dot, again blue dot in here, same thing. I just put the zooming thing. So you got that red dot right here, which corresponds to what I call the overbought pattern. And then you've got oversold pattern, which is quite the opposite. And then you had those dots. You may have wondered what those are. These are what I call overload patterns. Of course, I'm going to tell you what this relates to and what those patterns generally triggers to the prices and what you want to see when you see those patterns triggering. So let's just start with, for example, the bearish pattern, which is the most common one you'll see, as well as the bullish ones. Simply tells you that the momentum is very likely to keep pushing the prices, pushing the momentum, because these patterns relates to momentum, not necessarily through prices. So whenever you see bearish in here, you want to see prices breaking down support, but on price. When you see the bearish pattern on momentum, what you want to see is momentum breaking down the latest support, not necessarily the price. It can be two different things. We talked about that. Momentum is a price derivative, but it is not price. So whenever you have bearish momentum, doesn't necessarily the price will break supports. And whenever you see a bearish momentum not breaking support, then you'll know something is going wrong, and probably that momentum is actually bullish. So whenever you have momentum breaking down to new lows and not the price, you generally what we call the hidden divergent pattern, meaning that the momentum is pushed down, very far down, but not managing to make new lows. So you've got the hidden divergent pattern triggering in here. Okay? But once again, no triangle for sine waves, so there was no point trading those prices. You got no signal. The only signal you have is right there, and this is triggering a bullish pattern as well. So right here is a bullish signal. So bullish pattern, divergent pattern, only tells you that the momentum either has pushed too far and the price hasn't followed. This is what we call the divergent pattern. Either it's hidden bullish or standard bullish, or hidden bearish and standard bearish. These are the same. It tells you that the momentum has pushed far and the price is not following it. Then you got bearish, which basically tells you that we should have bearish oscillations of the momentum. And bullish says that we should break the momentum resistances. And what is new about momentum indicator here is that those resistances, as you can see, you got clear resistances in prices. This is what you call the trend lines and things like that. But you don't have trend lines out of momentum. It's hard to do it. So this is why I created this algorithm that is creating trail lines out of momentum lines. And these are considered as support and dynamic support and resistance. It's just like the trend lines you use on price. And whenever you have a bearish momentum, the first thing you want to see on price, and on momentum, is to see the momentum breaking down the potential trend line, trail line in those cases. That's how I call them. I want it to be called differently. It's not trend lines, it's trail line. It's the trail the momentum leaves behind it that can give him support or resistance whenever it reaches back to those prices later on. So in here, bearish breaking the trail line. So okay, good to go with the bearish momentum. What you want to see next is the momentum making new lows, which it did right here, but not the price, and this is why it triggered the divergent pattern. So, okay, you got those patterns. Then you got taking profit, basically telling you that you've pushed the price far enough, and you generally will have a retracement. Not necessarily meaning that the trend will reverse. All it says is that the oscillations of sine wave, momentum, has pushed the price way too far and very likely going to create retracements out of this, not necessarily changing the ongoing trend, just pushing the momentum to higher values when you've got bullish taking profit, or to lower values when you've got bearish taking profits. Really simple as that. Then you got the exit patterns. I'm going to search for one. There you got one. When you got exit pattern, just as in sine waves, the most aggressive signal you could get, when you've got exit out of the momentum, you really don't want to have bullish, strong confidence in such market. When you have exit, generally the market will break the trail line and break the bullish momentum as well. So all you can get out of an exit is a range at best, but very less likely to see the trend keep going on at that point. Okay. So same thing that we have in sine wave. In terms of strength, taking profit is the least probable reversal signal. Then you got bearish, bullish, divergence is quite the equivalent, and then you got the exit pattern. There is no breakout out of momentum, because breaking the momentum is simply breaking the trade line. So consider this as a breakout. Okay, real simple as that. Then you've got those dots. So overbought means that this is a bearish pattern. If the price is reversing nearby, meaning that if the price fails to break below that, beyond that, and reverses, then this is a reversal pattern, meaning that the price went overbought and bulls went out. Then bears took it over and reversed the price. So whenever the market reached that overbought situation, the bears took it over, means that this is a bearish pattern. Same things goes with the bulls. In here you got oversold momentum and bulls taking it over. Okay, really simple as that. This is a bullish signal. Now there is, of course, invalidation of that signal, and you have it right there. For example, you've got bullish, momentum is overbought, meaning that the bulls have pushed the price far enough and could potentially lose the hands of the price, lose hands on price. And whenever you see this, the market taking one or two candles, accumulating the price, and then bullish breakout of the signals and breaking the high of the candle that triggered the pattern and closing above it, you generally know that this market is in kind of bullish trends, and actually the bulls have more strength than the bears, because the bears could have taken it over at that point and they didn't, meaning that either they want higher pricings or they simply doesn't want to sell. It means that the bulls can take it over and create a trend. So you don't want to see a lot of red dots happening one after the other. You can see a couple, eventually up to 3, but no more than that. Okay? Otherwise, it means that you have a bullish trend ongoing. Okay, so overbought, bulls push it over, no problem. Second overbought, you manage somehow to make a close about there, simply closed, but the candle right after that came closing back inside the previous range. So this is basically a reversal pattern here. So you didn't break the resistance that was that overbought pattern. Okay, so whenever you have overbought pattern, you know that you probably found a resistance, and you want to see if the price is going downward or keep going upward. And if it goes upward, you probably broke a resistance. And then you've got those gray dots. I told you these are overload patterns. What does that mean? It means that the momentum has pushed really far. It's gone way further than what it should do. And whenever it does, it means that the price will go further than that generally. But at that point, it won't. It will probably stop the price from moving forward. Simpler retrace for a couple, meaning from 3 to 10 bars, and then will push further. Okay, just as we have right here, perfect example. You've got momentum overloaded, so the price ranging for a few bars before getting lower. Okay, same thing right there. Of course, whenever you have a gray dot triggering a pattern, the pattern is taking it over. So you don't want to trade when you have those gray dots. Consider them as invalidation. When you have this, you don't want to be trading bullish. All you want to be is bearish and keep the bearish trades going on until you get a confirmed pattern. And this is the confirmed pattern. When you have that taking profit in here, what you use is the taking profit, not the overload pattern. This one is getting above. Okay. So there you've got your bullish pattern. You've got sine wave confirming as well. This is where you wanted to take your profits, really. Okay, so once again, really easy situation right here. A really clear market with very easy to read signals in here. There will be much more complicated situation. Of course, we're going to dig into those as well. But you need to understand why momentum is there to confirm the signals. And from time to time, sine wave will tell you, okay, you're good to go, but not the momentum. And this is what prevents you from from entering wrong trade scenarios. And this is why those two indicators are complementing each other. They are filling each other's gaps. because sine wave is performing predictive analysis, and it can be wrong for many times and can get into tricky situations. And this is what momentum will get you out of, because momentum is reacting to price. So if price is not really showing signs of potential reversal, you won't have patterns to confirm and trade out of. And you cannot trade sine wave alone. And the problem with momentum is that momentum is really violent kind of indicator. Whenever the price reverses, generally you'll have a pattern triggering out of momentum. So meaning that if you trade bear signals out of momentum, you'll get very violent price reversal in which sometimes won't be in timing. It means that you will sell too soon or buy too early. And you don't want to do those kind of things. You really want to trade in time, reducing the risks of not showing the price reversing, and this is why momentum is taken care of. And you want to make sure that your opponents are at least probably getting out the market, or that the guys trading with you are probably getting in. If you're a bull, you want to trade with bulls. You don't want to trade when it's bear time, okay? It's really simple as that. And this is what sine wave is taking care of. So once again, no magic. The indicator will lead you into some kind of false signals from time to time, and you cannot avoid that. The key element to plot here is that whenever you know what you're using, whenever you understand what each individual indicator is taking care of, you'll have clear confidence out of your trading signals, and this is what you want. You want to have confidence in your signal. You don't want to overthink this. When you've got the double signals out of the indicators, and when this signal is happening where you forecasted it to occur throughout your step 2, which is the technical framework, because once again, if the signals occur into uninteresting price area, you don't want to trade those. You only want to trade signals when they occur into interesting price area and whenever you have a double signal. And when you check those 3 steps, generally you limited the risk the most you could. You can't do more than that. And even though you manage your risk very high level, from time to time the market will go on the opposite side anyway. And you have to give your stop losses in that case. You cannot predict the market, and never will be able to do it. No matter how close you look at the indicators, no matter how sharp your money management is, cannot be 100% winnings at all. So anyway, this was the presentations of the indicators. Of course, I strongly suggest you to take the free trial week, because don't take my words for granted. See how it goes on real-time market. Apply the indicators to your own charts, make your own studies, see how the signals react in time, and learn out of tricky situations, because this is where the demons are. Having really crystal clear signals and taking easy gains out of those, quite cool. But the goal is not to give away those gains and to avoid entering into tricky situations. But the signals are clear and really simple. If you want to trade, you need to have sine wave and momentum. Okay, and whenever you got sine wave giving you a taking profit pattern confirmed by a momentum taking profit, you don't hesitate. You take partial profits. And if the price goes lower or higher, if you're trading bullish, no problem. You at least secured your profits and you did what you had to do. Really simple as that. So once again, you simply try the indicators. No one will push you in or force you to stay in. You stay in as long as you use the indicators. And as always, the educational content that you will have in here all along the YouTube channel with the daily videos, all you have in TradingView with the ID sharings and all the educational content, whenever you are inside the Discord channel with all the other members helping you out, all of this is and forever will be for free. And really this is never going to change. I have real value for that. To me, information is priceless. So it cannot put a price on this. And for that reason, it will always be for free. No matter if you're using the indicators or not. I'll give you the educational content as well. So there's always good things to take out of this, even though if you're not trading with the indicators. You'll have access to this. You can join the Discord as well. Lots of the guys will be using the indicator for sure, but if you don't, no one will push you out. You can take what you want to take in there. All I care about is you sharing. If you go in there and take out of what other will give you, then give to someone else's afterwards. If you take, then you give. Really simple as that. Has to be sharing kind of Discord like. Okay, so I hope you guys will like the indicators anyhow, and if you don't, you're free to get out at any time. It's just a pay-as-you-go system. You pay €1 a day. If you use it today, €1. Not using it for 1 or 2 weeks because you're out of vacations, because you're out in vacations, then simply pause the subscription. Don't pay for something you won't use. Just enjoy your 2 weeks vacations, and whenever you come back, you resume the subscriptions, and I'll give you the access back in, and that's just 20 days you won't have paid for nothing. Really as simple as that. Pay as you go. It's not meant to ruin you anyhow. You won't pay. You pay for the whole package. I don't want you to pay for one indicator, because you may have guessed at that point one indicator is worthless. It's really combining the two that is key to success, and understanding how they work first. So take the trial week, learn a lot, see if this fits you, and if it don't, you're good to go. No problem. I don't really care. It cannot fit everyone. So if you don't like it, get away and move on. You will have learned quite a few interesting things anyway, and you're good to go with that. I'm going to leave you with this. I suggest so you join the Discord with us. You can subscribe to the YouTube channel as well. Follow on TradingView and any kind of things like that. The most valuable thing here is not the indicator, it's the knowledge I'm sharing with you guys, and this is for free.